Another day, another story. Today we will discuss the understanding about cost of financing a company's operations and how to optimize the capital structure to minimize the cost of capital financing company's operations and optimize the company's capital structure to minimize the cost of capital. We will explore the concept of cost of capital and how it affects a company's financial decisions. We will also discuss various ways to optimize a company's capital structure to reduce the capital cost, which is the total amount of money that a company needs to spend to finance its operations. In other words, it is the cost that a company incurs to borrow funds from lenders and investors. It includes both the cost of debt and the cost of equity. The cost of debt is the interest rate that a company pays on its debt. This interest rate is based on the risk associated with the company's ability to repay the debt. For example, a company with a high credit rating will have a lower cost of debt than a company with a low credit rating. This is because lenders perceive a lower risk of default from companies with a high credit rating. The cost of equity is the return that investors expect from investing in a company. Investors expect a higher return on equity investments as they carry a higher level of risk than debt investments. The cost of equity is based on the company's profitability, growth prospects, and other factors that impact the investor's perception of the company's risk. Optimizing a company's capital structure can be achieved by finding the optimal mix of debt and equity financing that minimizes the cost of capital while balancing the company's risk profile and financial objectives. Here are a few strategies that companies can use to optimize their capital structure and reduce the cost of capital. Debt-to-equity ratio. One of the primary ways companies can optimize their capital structure is by finding the right mix of debt and equity. Companies can increase their debt levels to reduce the cost of capital by taking advantage of the tax benefits associated with debt financing. However, too much debt can increase financial risk and harm the company's creditworthiness. Therefore, companies must find the optimal debt-to-equity ratio that minimizes their cost of capital while managing their risk profile. Use of preferred stock. Preferred stock is a hybrid security that combines the characteristics of both debt and equity. Companies can use preferred stock to optimize their capital structure by reducing their reliance on debt and increasing their equity base, which can help reduce their cost of capital. Repurchase of shares. Companies can optimize their capital structure by repurchasing shares, which can help reduce the number of shares outstanding, increase earnings per share, and improve financial ratios such as return on equity. This can make the company more attractive to investors and reduce the cost of capital. Refinancing debt. Companies can optimize their capital structure by refinancing their existing debt at lower interest rates, which can reduce their cost of capital and improve their financial position. Timing of capital raises. Companies can optimize their capital structure by timing their capital raises to take advantage of favorable market conditions. For example, if interest rates are low, the company may want to raise more debt, while if equity markets are strong, the company may want to issue more equity. Optimizing a company's capital structure involves finding the right balance between debt and equity financing. The capital structure of a company refers to the mix of debt and equity that it uses to finance its operations. Debt financing involves borrowing money from lenders and repaying the principal and interest over time, while equity financing involves raising capital by selling shares of ownership in the company. The optimal capital structure for a company depends on several factors, including its industry, growth prospects, cash flow, and risk profile. In general, companies aim to strike a balance between debt and equity financing that minimizes their overall cost of capital while also maintaining financial flexibility and minimizing financial risk. Having too much debt in a company's capital structure can increase its financial risk and make it more vulnerable to economic downturns or unexpected events. On the other hand, having too much equity can dilute ownership and reduce the potential returns for shareholders. Therefore, finding the right balance between debt and equity is crucial for a company to achieve its long-term financial goals and maximize shareholder value. Thanks for watching.